what are you hearing? Do you have access to your funds?
We do. We started hearing rumors Friday that there might be issues, so we acted fast and we actually pulled most of our capital out there. The bankers at Signature on the phone told us, listen, we know as much as you do right now.
Sure.
And our response was, okay, it's better to be safe than sorry. We moved it to other banks we have relationships with. They were back in the office on Monday. We had access to all the capital call lines.
With Signature.
With Signature. So they're back in business. Obviously, we're taking a more cautious approach. We're hoping they will be truly back in business on the longer horizon and we'll be happy to stay a long-term client of the bank. There's great people there, but right now, you got to be careful.
I mean, you're in the middle of like so many different hurricanes right now. I don't even know where to start. Let me kind of throw it back to you, actually. So you've been in the middle of the banking problems with Signature. Your firm focuses on commercial and residential real estate, both of which, remain under pressure. What keeps you up at night, or do you see this as some kind of opportunistic environment to be in?
I see it as kind of the golden age for private lenders like ours. We're a closed-end debt fund. We provide first mortgage loans predominantly on residential, commercial properties, mostly in New York, so a lot of multifamily, a lot of condo buildings. And, we look at it case by case, deal by deal. And right now, I have to say, the New York residential market looks pretty resilient. Because
everyone's depending on it. You have rents at all-time highs, basically, even with the biggest number of apartments coming online, and it sounds like decades. Does that worry you at all?
We actually see the supply glut that everybody spoke about pre-COVID. That has evaporated. Right now, there is a shortage of supply. No one has really built a new product in the city in the last 3 years. Everything you're seeing coming online right now is projects that started pre-pandemic and are just finishing in. So we're actually providing the capital for those projects to be able to get to the finish line.
Would you be involved in any office conversions, or could that, people talk about it like that's the answer here, but it's also very difficult to do and will probably take some time.
It's complicated. It's more complicated than people think to convert an office building to resi. We have looked at a few of those. We haven't transacted on them yet. It has to be at a certain basis for it to make sense, and the layout really need to work. But that's going to be definitely a trend. We know of about 6 million square feet of office building right now in Manhattan that's going to get converted. It will take them probably 3 years to get to the finish line. So the supply shortage will not get fixed immediately by those projects.
Do you feel good about the return on investment you're probably going to have for the next couple of years? Because getting to this point, everything sounds great. From here on out, things look really dicey in terms of the economy, in terms of where rents might go if we do have a recession and all of that. How do you, confidently invest here?
So you have to underwrite the sponsor ability to cover the loan and to cover rate increases. You have to underwrite the property itself and the liquidity of that specific asset. So when you look at New York residential, it's much more liquid than real estate properties in other parts of the country. Listen, right now, banks are pulling back in a major way. We are stepping into loans and type of sponsors that typically would get a loan from a large commercial bank.
It's a huge opportunity for you, but are there enough of you to make up for that loss of funding from the banks?
No, there's not. There's a lot of debt funds that have raised significant capital, but definitely in order for the market to be robust, you need the commercial banks back in the game. It's going to be a very interesting year. I think that right now we're seeing spreads increase, meaning we're getting more returns on our loans, and we actually reduced our loan to values, meaning if a year ago we typically lend at 65% loan to value, this year we're more at 55%. And if last year it was more second-tier developers, this year it's top-tier sponsors and assets. So higher quality, more return, but bigger systemic risk that you have to mitigate.
Be worried about. Absolutely. Well, and people wonder, how are we keeping things going right now? You're a prime example of that. Ran, thank you so much for coming in. We appreciate it today.
Pleasure.
Ran Eliasaf with Northwind.